Accounts payable. Imagine your company's bank account has a leak. AP reconciliation is the shield that stops that leak. It's not just about math. It's about making sure you aren't paying for things you never received or getting overcharged by mistake. Key principles simplified. 1. Verification. Double-checking the small books against the big books. 2. Documentation. Keeping the receipts so you don't get in trouble during an audit. 3. Variance tracking. Being a detective when the numbers don't match. 4. Segregation of duties. Making sure the person who approves the bill isn't the same person paying the bill to prevent inside jobs. Think of these as the golden rules for a clean audit. Use authorized adjustment docs. If you need to change a number or fix a mistake, don't just delete it. Use an official adjustment form. This creates a paper trail so everyone knows who changed what and why. Match supplier statements to GL. Your supplier thinks you owe them $5,000, but your general ledger, GL, says $4,500. This practice is all about sitting down once a month to make sure your math matches their math. Monitor purchase volumes versus payments. This is your early warning system. If you usually buy 50 boxes of paper but suddenly get a bill for 500, something is wrong. Watching these volumes helps you catch unauthorized or ghost bills before the money leaves the bank. Part 2. Critical challenges. The cons. These are the 3 things that keep AP managers up at night. Human error. The fat finger problem. One extra zero or a misplaced decimal point can cost thousands. Plus, physical invoices can get lost on someone's desk or buried in an email thread. Processing delays. We call these exception invoices, the ones that don't match the purchase order. They are huge time wasters. They sit in limbo while people trade emails, causing late fees and stressed out vendors. Security risks. Without automation and strict checks, your company is a target for fraud. Scammers send fake invoices that look real, and if your process is manual, it's much easier for them to sneak through. The reconciliation workflow. Step-by-step. Step 1. Baseline validation, the starting line. Simple explanation. Before you move forward, you have to look back. Does the amount of money you ended with last month match the amount you're starting with today? If your starting point is wrong, everything else will be too. Step 2. Journal audit, the manual check. Simple explanation. Computers do most of the work, but sometimes people have to type things in by hand. Manual journal entries. This step is about hunting down those handwritten entries to make sure they are correct and authorized. Manual entries are where most mistakes hide. Step 3. Variance analysis, the detective work. Simple explanation. This is the why is this different phase. You compare your internal reports to the main ledger. If the numbers don't match, you investigate. Did we miss an invoice? Was there a double payment? You find the why before you move on. Step 4. Posting confirmation, the data move. Simple explanation. Think of this as checking your luggage at the airport. You're making sure the data moved from the subledger, the small detail list, to the general ledger, the big main book, without getting lost or scrambled in the system. Step 5. Period finalization, the finish line. Simple explanation. Finally, you put a lock on the month. You double-check that every single bill is recorded in the right time period. You don't want a January bill showing up in February's reports. Once this is done, the month is officially closed.